Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, Partner and our lead analyst. So thanks for joining me today.
Yep, thank you, Shannon. Welcome, everyone.
So in today's webinar, which will last 45 to 60 minutes in length, we are going to be talking about the overall markets and the economy. In doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, for compliance purposes, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last couple of weeks. If you have any specific questions regarding those reports, please feel free to contact your SilverOak advisor if they've not already contacted you. And of course, if you have any questions throughout today's webinar, I highly encourage you to reach out to your SilverOak advisor after the session. If you're not currently working with a SilverOak advisor, you can contact me directly at 952-896-5701. And I also want to take just a minute here to thank Jonathan and John and the rest of the team that put the materials together. It really does take quite an effort to get everything together in such a timely fashion. And also thanks to the rest of the team that puts together the technology and other components that go into delivering the webinar. And of course, as compliance officer, I couldn't go without saying that past performance is no guarantee of future success. So let's take a look at today's agenda. So Jonathan, we're going to start off as usual talking about the economy and walking through the SilverOak dashboard. Then we'll spend a few minutes talking about market performance, and then go into our outlook as we look over the next couple of quarters and beyond. We always like to give a few SilverOak updates, and we've got some that we'd like to share with you today. Our next section will be a discussion around enduring market cycles. Unfortunately, an inevitable component of investing is going through market cycles. And of course, if there are any questions, as I mentioned, please feel free to reach out to us at the conclusion of today's webinar. So Jonathan, let's talk about the economy and the dashboard. Give me just a big picture snapshot.
Essentially, the economy is like the ever-ready bunny. It just keeps on going and going. Last year, at this time, majority of economists thought we would be in a recession by year end. Here we are entering this year. That expectation has fallen, but it certainly isn't zero. And we'll show some things, that we do have to consider.
So with that, then, let's take a look at the components of the dashboard. And as most people know, but if you're new to the webinar, we break our dashboard out into 4 components. The first component is the economy. And if we look to the far left, we show the third quarter of 2020, and then on the far right is our projected second quarter of 2024. And of course, right next to that is the first quarter 2024 actual data. If the square for the quarter is red, that is considered negative. If it's gray, it's neutral, and green is positive. So we can see here that first quarter, the economy is neutral, neither strong nor weak. And by the way, there are 11 factors that go into this economy component of the dashboard. And we'll talk a little bit about 1 or 2 of those in a few minutes. How about the credit markets?
Credit markets are neutral as they have been, and I would say at this point, there's really not a lot of changes that we've seen in the credit markets.
Valuations continue to be negative, meaning valuations are high, and we'll talk about valuations a bit more in a few minutes. And then the fourth component is market sentiment, which does remain positive. So if we take all four of these and we wrap them up into the composite itself, we end up still negative. That's been the case over the last couple of quarters, but as Jonathan mentioned, that doesn't necessarily mean that we're in a recession, because frankly, we have not been over the last several quarters.
And actually, while it's still negative, it's actually a little less negative than last quarter. And we're going to show you that.
That's a very good point. We have that right here on this slide, where we can see that things have improved off of what was kind of a trough in the composite in April of 2023. So the arrows signifying that movement up, and then those circles are signifying where we currently are, both under the current dashboard composite and the 6-month average dashboard composite. And just to make note that that line going across, that straight line going across, that's kind of a threshold barrier between what we consider to be more positive versus more negative. So we're coming off of the more negative, barely kind of crossing or getting to that point of crossing the threshold into a bit more positive. Anything further you'd like to add on that?
Not at this point. Certainly, in terms of projections, we're projecting that next quarter will hit neutral, and that is really, we're projecting that the 6-month number will hit the threshold.
Got it. So we did get one question, Jonathan, after our last webinar from a participant who asked how we use the dashboard. So it was a great question, because we talk about the dashboard every quarter. So I went back to the first time we presented the dashboard in one of our webinars, and it was in April of 2017. And this is actually the dashboard from that specific webinar that you can still see on our website. So if you went out to the SilverOak website and went to these webinars, you could scroll down and find the April 2017 webinar, and this is the slide that we would have. When we first introduced it, if you listen to that webinar, we indicated that this is really not a market timing tool. We also noted one of the major weaknesses in this tool is that it's entirely US focused. Okay, we have no components of the international economies worked into this. In addition, there can be differences in the magnitude of the dashboard movement relative to the market movement or reaction. So, you know, like many market timing tools or indicators, even ones that seem to work relatively consistently, they work until they don't. And so we don't want to use this tool as a tool that we trade on. As a matter of fact, we don't really consider ourselves to be traders anyway. We consider ourselves to be investors. So we use the dashboard to help us determine our conviction and to shed light on where we believe the economy and markets may be in a way that's void of static from the media, or void of static from others in the industry, or maybe even from our own personal biases and views. So it can be an objective tool in setting expectations. Now, what I found interesting is if we look here from the April 17 dashboard, you can see that the dashboard composite started to drop pretty considerably in 1998. And then even more so past the threshold, that black line going across, in 1999 or 2000. And that was shortly prior to then, of course, the market having a big pullback in that 2000 to 2002 timeframe. And then we, of course, saw the composite then move up, and therefore the market shortly thereafter moved up. And the same here, where the composite started weakening, then broke a threshold, and we saw after that the market really reacting, and vice versa on the upside. Again, in none of these cases do we use it as a buy trigger or a sell trigger, but it's more a tool to help us determine our conviction for the markets and the economy.
I think the only other thing I would add is kind of looking at turning points as well. When the dashboard is really, really high, that's not telling us that, oh, we need to increase our equity exposure, nor does it mean when it's low that it's telling us that we should be selling our equity exposure. Right. And that's really why we don't use it as a timing tool.
Right. Yeah. I mean, again, any timing tool only works until it doesn't work. And sometimes when it doesn't work, it can be very painful if you've committed too much to the strategy. All right, so I appreciate that question coming in. Hopefully we addressed that. If not, feel free again to reach out to your SilverOak advisor or to me with any follow-up questions. Next, we're going to focus on a couple of the factors that go into the composite. So we'll start here with the economy as one of the 4 components, and one of the 11 factors of the economy is the ISM Manufacturing Index.
So the manufacturing part of the economy has been the weakest part of the economy over the last couple of years. What we actually saw last month was it ticked up to 50.3, so right just slightly above positive. And that was actually the first positive month that we've seen following 16 consecutive months of negative numbers. So what this is potentially telling us is that manufacturing might be in a bottoming process, maybe improving on the margin. It is not necessarily telling us that the manufacturing economy is going to boom.
Sure. Another component of the economy is unemployment. And that has just been astonishingly consistent.
Yeah, absolutely. It has defied people's expectations. Where we are with the economy, I think people thought we would be at 4.5% unemployment. Instead, we're actually seeing pretty decent job growth. We're seeing pretty decent wage growth. I think this is a factor that is helping the economy. Obviously, if we were seeing the unemployment hitting, higher numbers, bigger layoff numbers, I think that we would be seeing a weaker economy.
Yeah, definitely. I mean, when consumers drive 2/3 of GDP, and of course, a lot of the spending that comes from consumers is predicated on having a job. If unemployment remains low, you would assume people will keep spending. The next component of the economy that we're going to look at is housing.
Yeah, so in general, housing has gotten a little bit better, and you can kind of see that. However, we also know that in the last month, mortgage rates have now hit 7% again. And so housing start numbers this last month were actually pretty weak. Yeah. So I think this is still an ongoing story that is going to be very dependent on interest rates and mortgage rates.
Sure. And it doesn't mean that mortgage rates have to get back down into that 2.5 or 3% for housing to flourish again. But certainly, as you said, at 7%, it puts a little strain on that part of the economy. Let's transition now from the economy, which again is one of the 4 major components of the composite of the dashboard, and let's go to credit markets, the second component.
Yep. If we look at the far right, you're going to see kind of where we are currently. Not a lot of changes in the last couple of quarters. That's why I said earlier that the credit markets, I think, aren't really hurting nor helping. Certainly with high interest rates, the thought would be that the economy would be slower, and this is really what this is measuring. We're in a situation where short-term rates are higher than long-term rates, so it's inverted, so to speak. In the past, it was a good indicator for a slowdown in economic activity coming. We haven't really seen that, but one of the things, we're watching is if rates stay at where they are for longer, we know that banks really are not lending, and we know that there are definitely some needs among smaller businesses. So potentially that's still coming.
Well, and one thing, and we don't really address it in today's webinar, but this time around could be different. And I always kind of hesitate when I go to say that, because usually things aren't all that different. But with your comment on banks not lending a lot, this time is a bit different than what we've seen in the past, because we've got a lot of private credit that stepped in to do what banks had done in the past. And that might be helping, especially small businesses that are looking to raise capital. They can't get it from the banks, so they're going to private credit. And on the private credit side, we are completing some due diligence here in SilverOak to determine if we're going to add private credit as one of our IQs, our investment quality scoring system positions to offer to clients. Let's talk about spreads. Just in general, where are we with credit markets and spreads?
Well, so interestingly, if we look at that high yield spread on the far right with that upper arrow with the question marks, and yet when you look in the circle, if anything, credit spreads have narrowed.
Mm-hmm.
And I think that is kind of synonymous with what we've seen in the unemployment rate. And so basically this is a signal that from a spread standpoint, bond investors are not concerned about the economy and a potential recession.
Mm-hmm. Well, let's touch on a really important component, and that's valuations, or in this case, specifically corporate earnings.
Yeah, so valuations are high, and so last year, much of the return in the S&P 500 came from valuation expansion. Now here we're looking and thinking about earnings. Earnings are projected to increase this year, but the thing I will mention is that we've never really ever had a year where earnings expectations were negative.
Mm-hmm.
What ends up happening, and we'll talk about this later on another slide, but expectations can come down pretty significantly. But I think if valuation can get some help from earnings growing this year, then the markets by year end might not be as expensive, even if markets kind of stay at current levels.
Sure. And then the next component of the dashboard is, of course, sentiment. And here we're showing the market trend. So touch on this, especially the 50-day, 200-day differential.
Yeah, if anything, if we look right in that red circle, you might say that the market could be a little bit extended. It has had a huge run from the low in October. And, so one of the things we've talked about is when the 50-day moving average crosses through the 200-day moving average, that's significant. That happened last year. But you can see the slope of that 50-day moving average, which is green, is pretty vertical. And what we do know in the last week or two is that the market is actually below the 50-day moving average, which isn't as big of a signal as the 50 crossing the 200. But typically when we see the actual market cross through the 50-day, that is a shorter term signal that maybe we're in kind of a consolidation or pullback period in the market.
Yeah, and that should be no surprise. I mean, we had an excellent 2023. So far this year, we've had an excellent year to date, even taking into account the last week or two, most markets are up. So to see a pullback should actually be expected at some point.
Yeah, absolutely. And we'll address this later, but you know, the markets many times are at new highs or creating new highs. And so one shouldn't shy away from the market long term when you're seeing that, nor should you shy away when the market is in consolidation mode.
Exactly. So let's transition now to discussing market performance. And just looking back over the last quarter, you'll see here every one of these equity sectors positive. And by the way, these may not seem all that impressive, but keep in mind, these are just the year-to-date quarterly numbers. These are not annualized numbers. So if you annualize these, they would be utterly ridiculous. Of course, if we look back over the last year, again, coming off of 2023 being such a strong year, the numbers look even more impressive. If we transition over into bonds, little different story here. The first quarter wasn't particularly kind to bonds. We'll talk a little bit more about that as we get into the details. Certainly not global bonds, and that's going to be a discussion around the US dollar and the strength of the dollar. If we look over the last year, maybe a little bit better. Obviously, bonds did have a pretty decent 2023 after coming off of just an absolutely horrible 2022, which we'll talk a little bit about as well. Let's touch on growth versus value, though. So, Jonathan, which is doing better?
Well, it continues to be the story of growth. So growth last year outperformed value. We're seeing that as well in the first quarter returns, and then obviously over a 1-year period. But again, absolute returns are still pretty good for value, but certainly growth has far outperformed.
Yeah. And as we talk about US versus international, where do we see the strongest performance?
Well, interestingly, you know, international has been impacted by the dollar. You mentioned that on a prior slide. So we are seeing lower returns in international relative to US markets. But I really do want people to focus on the far right and look at Japan. Because even Japan being up 11% in the quarter, in local terms, it was up almost a little below 20%.
Wow.
Really strong. Thinking back, back 10 years ago, we talked about Japan quite a bit.
Mm-hmm.
And then obviously they had a lot of issues, and it really hasn't been an investor focus now for a decade. But in the last couple quarters, in the last year, Japan has seen more growth. And as a result, its markets has responded, and valuation in Japan is actually pretty low.
And they're starting to see that dreaded I word, a little inflation.
Yeah.
I mean, like little, not nearly to the tune of what we're seeing, but
right. I mean,
it's a couple decades of nothing.
In the U.S., we believe, you know, the Fed target at 2% is a good rate because that gets people to spend. You know, you just never know what happens if Japan actually kind of restarts that consumer spending.
Exactly. Bonds, I made reference to bonds just a few minutes ago. Obviously, for the quarter, most bonds were kind of break even to down. For the year, they're still up across all of the categories predominantly, but what's going on with bonds?
So obviously, bond performance has been weak due to interest rates increasing in the last quarter. What we did see, though, on the left side, emerging market and high yield, those are credit-oriented areas of the bond market. And we showed on the slide how high yield spreads were actually still coming down. That has led to outperformance. So when we look at the trailing 1 year, emerging market, high yield, clearly did the best, and that was because credit spreads narrowed.
Mm-hmm. So as we think about moving forward, the outlook that we have, both we'll go through both the economic outlook and the market outlook. For the U.S. economy, we still believe a soft landing is possible. It's probably too early to declare, but I don't think it's off the table either. It certainly is possible. There is that risk we talked about with higher interest rates that could impact ultimately the consumer, particularly if we start seeing unemployment go up. It is a bit of a challenge I think the Fed has gotten themselves into, because I know they kind of want to lower rates, but at the same time they don't really want to, because the economy is doing so well. Why lower interest rates when the economy is already doing so well and you've given up an arrow in your quiver? But at the same time, obviously the markets are really challenging the Fed in pushing through lowering of interest rates. So we'll see ultimately who wins. Service inflation, that's definitely proven to be more sticky, and that could be the challenge that the Fed has with inflation. For the international economy, I mean, even all the happenings overnight, I mean, it's not any secret to say that there's geopolitical risk and global issues that are happening right now that could be detrimental to the economy and frankly the markets.
And what I would add is, depending on how that plays out, we did talk about how the strong dollar hurts international returns. Well, with a lot of geopolitical risks, we could be in a period where there's a flight to the dollar as a result, which could impact the economy internationally and markets to a certain extent.
Very good point. Very good point. So here we talk about the U.S. economy and the fact that it's been surprisingly strong. We mentioned it a couple times. So what do you want to show us here in this slide?
So this is just a slide showing you kind of economic data. You can see on the far left, there's red. So economic data at that period was not meeting expectations, so the expectations economists had. And then here we have just this past year or more of basically blue or above the line, meaning that economic growth has and data points have exceeded what economists were expecting.
And this touches on probably one of the big catalysts, one way or the other, in the economy. And this is talking about high interest rates and spending.
Yeah, they've been high, they've been elevated. We talked about mortgage rates ticking back up. We've talked about high rates, the fact that banks aren't lending. So if the Fed goes into a scenario of not cutting rates this year, that's where the concern would be, that maybe then it does actually start to hit the economy.
And on the left side of this, we're showing credit card rates. So we're saying that in the last couple of years, rates on credit card debt has gone from, say, 14, 15% up to almost 22%. That is just ridiculous.
Yeah.
I mean, I'm not a big government regulation person, but 22% interest rate on a credit card.
Not quite reaching maybe loan shark levels.
That is crazy.
But it is really, really high.
Anybody that gets themselves into any trouble at that interest rate, you pretty much could never get out.
Yeah.
I mean, it's just astonishing. Well, and here's a big component too of inflation. Actually, we're gonna have two slides. Yep. Shelter, and then I think the next one's going to be insurance.
Yeah, so here we're looking at CPI over time. If you look on the far left, you're going to see green, energy. That was a big factor. Then we saw core goods, the orange color, and then we look at the purple, food at home. So we were definitely seeing more goods inflation at that point, and that's kind of gone away. And then if you look kind of towards the middle and to the right, you'll see the green, actually was negative. Energy prices were coming down on an absolute basis. And so then if we look at the far right and you look at that arrow to the dark blue, that's shelter. So that is rents, homeowners equivalent rents. And you're going to see they were higher back in early 2023. They've come down, but not enough to get closer to that 2% target. And so that's where a lot of the stickiness, comes in. And right above it, you're going to see the red, which is what we're going to address on the next slide. And here we're taking out shelter and then showing the other components in there. And so you can see that outside of shelter, the biggest component recently has been auto insurance. And so auto insurance rates were up last year and they're up again this year.
Mm-hmm. All right, let's take a look at our market expectations. So equities, we already mentioned this. We may be in early stage of an intra-year pullback. Obviously, we're in some type of a pullback over the last week or two. Whether that continues is really anybody's guess. I think a lot of it's just driven off of the day-to-day, news flash of what's happening in Israel and with Iran and et cetera. Which, by the way, we are going to show a slide in a few minutes that shows these types of events really don't have that much impact long term on the markets. They do certainly on a day-to-day basis, but if you look past that fog of the day-to-day, long term, they really don't have that much impact. So momentum certainly could be slowing. Some people are probably doing a little bit of profit taking, but as we mentioned earlier, pullbacks are normal and should be expected. We also should expect volatility to pick up. It's the election year, probably an election year like none other we've experienced. So we should expect maybe more volatility as a result of that as well. But there are still a lot of positives. Price momentum we talked about. Performance is broadening. We'll touch on that. Valuations outside of what are called that Magnificent Seven aren't really that expensive. And earnings outside of the Magnificent Seven could actually begin to recover. And that obviously is very positive for the markets. Now, when we talk about momentum, boy, this is quite a chart to touch on.
Yeah, so basically, so far this year, and again, this is through the end of the first quarter, it was the 15th best start for stocks historically, going back to 1926. If you look on the far right, when we look at the next 9-month period, certainly there were 2 years where we did have negative returns, so it's not 100%, but again, many of those years we did see positive performance through the balance of the year.
Yeah. Now I will point out one of these. So in 1987, the Q1 started up 21%. The next 9 months were down 13. So years still to end terribly. Other than if you think back to what happened in 1987, October 19th was Black Monday, a day in which the Dow Jones dropped 22% in a single day. I mean, that is just astonishing to me. I mean, when we have market movements of 2% these days or 3%, people freak out, and nightly news is like, oh my gosh, the stock market dropped 3% today. I just can't even fathom 22%. I remember it, but I just can't believe it happened.
Yeah.
Let's talk here about, again, continuation of that power of momentum.
So here we're looking at kind of the cycle from October. And so we're really looking at November, December, January, February into March, then kind of what happens through the balance of the year. So if we look kind of where the red circles are in the bottom, April tends to be a good month. Now, April is now down. So, we'll certainly have to look at that. But if you look out to the second quarter, or even looking at the final 9 months of the year, this really echoes what we showed on the last slide, is that historically speaking, when we have this strong price momentum, it tends to carry.
But like I said at the very, very beginning of the webinar, all of these kind of statistics work until they don't work.
Correct.
But we are seeing some positive signs in the broadening of the market, and that tends to be healthy.
Yeah, absolutely. So here, what we're really looking at is that blue part of the circle, and that's showing that in the last recent period ending in March 24th, there was 27% of the S&P that actually achieved a new high. So last year, it was the year of the Magnificent Seven. And this year, we are seeing that broaden a bit.
Sure. And this touches really on that Magnificent Seven too, because here what we're seeing are the PE, the forward anyway, PE ratios, and the Magnificent Seven is like crazy, 32 times. The S&P is only at 21 times. Whereas if we equal weight, because which by the way, some people may not recognize, the S&P 500 is actually capitalization weighted, meaning that the companies that are biggest have the biggest impact on the S&P, and the smallest companies have the least impact. So if you equal weight them, every company kind of has an equal impact. So if you look at just the S&P, obviously it's being driven by some of the larger companies pushing up the valuation to 21 times, versus if it's equal weighted, it's more reasonable at that 17 times. Okay. But really, it all comes down to earnings at the end of the day, right? I mean,
absolutely.
Companies aren't growing their earnings. Ultimately, their stock's probably not going to grow either.
Yeah, so just to give you a reminder, in 2023, earnings for the S&P were up 1%, but more than 100% of that earnings growth came from the Magnificent Seven, meaning the rest of the market actually had earning declines last year. And so we start the year with the expectation in the US that earnings are going to grow, 10, 11%. Europe 5%, the emerging markets up 20%. But I will caution you that, again, every year we have the expectation of positive earnings growth, and it doesn't always happen.
Well, and almost always it starts high at the beginning of the year, and even if it ends positive,
yep,
it usually is less than where it started.
Yep, absolutely. And so really what we again need to see is a broadening of that earnings growth beyond the top 7 companies.
Yes.
And that would do a lot to help the valuation of the market.
And support the valuation. I always explain valuations
Absolutely.
and earnings as kind of a stair step, right? Valuations usually step up one, and then you have to wait for earnings to catch up.
Right.
And then valuations go up another step, and then earnings have to catch up. And there's this constant stair stepping of the markets, which basically causes the market over time to ultimately do nothing but go up. But it can be volatile along the way, for sure. Let's talk about our market outlook as it relates to bonds, because admittedly, bonds have been a bit of a disappointment so far this year. But I think the Fed and the bond market are probably a little bit more in sync now. Fed is still likely to cut maybe later this year. We came into the year expecting 6 cuts, or at least the market expected 6. We actually didn't, but the markets did. Looks like the market's now expecting probably 3. And what do you think, Jonathan? Maybe
I
1
think
or 2?
It's now that 3 might be rounding up.
Okay.
So we're less than 3. It could ultimately be 2. And some people are questioning with the economic growth that maybe we're in what's called a no landing scenario, where inflation doesn't come down, so the Fed really won't cut, but growth will just continue.
Yes.
So
Yeah. And frankly, unless things change, that kind of seems like the most probable outcome. Now, this stuff can change quite quickly, but I mean, we haven't seen the consumer pull back, and growth continues to occur. We do expect bond volatility to continue, at least until we get more direction on exactly what the Fed's going to do, when they're going to do it. We would suggest embracing more intermediate duration bonds. Short-term yields probably have peaked. I mean, we can't be for certain, but certainly would think that if you're still in cash, that you're going to be subject to reinvestment risk here over the next couple of quarters. We do believe, unlike in 2022, which admittedly in 2022, equity markets were down, bond markets were down. Bonds weren't down as much, but they were still down a historical amount. We do believe that if we do see a slowing of the economy that negatively impacts stocks, that bonds will provide more protection this time around than what we saw in 2022. And we actually have a slide in a few minutes that will touch on why. But back in 2022, we were literally starting, Jonathan, at 0 interest rates.
correct.
So as the Fed raised rates, it was very impactful on bond prices.
Yep. And we can actually just walk through that in that next couple slides when we go through that. But
Yeah.
here, you know, basically, it's a little bit hard to see on the right, but you're gonna there's kind of a green and blue diamonds. They're actually now kind of on top of each other. That's where we're saying that the Fed and the market is in
More
sync.
in sync. Yep.
Yep. And so again, likely 3, but really now we're open to maybe 2 or only even 1.
Sure. And of course, let's touch on bond returns, because there's a couple of components of bond returns. So why don't you touch on the various components?
Yeah, so if we look over time at the gray, you'll see that in the bar charts. But if we really focus down to the coupons right in the bottom little chart, you're going to see from 2004 to 2023 that bond coupons were almost 4%. So the coupon yield actually during this period made up more than the actual total return. And so
the total return was 3.2%.
2%.
The coupon was 3.8.
Yep.
So it was price depreciation, basically.
Yeah, absolutely. So if we look at kind of what's happened year to date, what we've seen is the change in treasury yields driving down price, but we've really only collected 1/4 of this year's coupon.
Got it. Got it. And of course, just like with stocks, bonds can be volatile. Not as volatile typically, but they don't guarantee. They're not fixed price investments. So year to date, they've been down as much as 3%. Frankly, they're probably close to 3% right now.
Right.
With the last week or a couple weeks of activity. But that's not unheard of in historical terms. As a matter of fact, if you look across the left as you go, you'll see the red dot. That's the intra-year low for the bond market for that particular year. In most years, there's a negative intra-year low even on bonds. But also in most years, bonds still end positive. And with the higher coupons that bonds are getting, all we need is interest rates to stay relatively stagnant and you've got better returns. If rates come down, you've got really good returns. And we're going to show that in this next slide.
Yeah, so here, if we look at, you know, 10-year yields are right around 4.5, 4.6%. Now, if we're wrong and short-term interest rates go higher and that pulls the 10-year up and it's a full 50 basis point or 0.5% increase, actually the coupons actually take care of that. It's really in a scenario where yields would go up a full percent that we would see more price loss. But if we look at what happens if interest rates go down 0.5% or even 1% from here, you're going to see that, again, very good price recovery from what we've seen. And we were talking about earlier what happens when you're at 0% interest rates and yields go up. So again, if we look to the far right, a full 1% change, you're looking at, a 9.5% price loss. And that is really what we saw in 2022. We're in a much different scenario today.
Yeah, much different. I mean, if the Fed had to raise another 400 basis points or more, it would be, that would be, I don't know, I won't call Armageddon, but that would be a crazy scenario to even expect. So with that, let's transition into our SilverOak updates. So first of all, big round of applause. Yahoo, tax season is over.
Unless you extend it.
Anyway, thanks for popping the bubble there. Yes, unless you extend it. Although we have until October 15th to worry about those returns. As far as SilverOak personnel, I am very pleased to announce that we did hire a new administrative assistant. So Allie's now a member of our team, and we welcome her. She's done a great job so far in the onboarding. Very excited for the opportunity to work with her going forward. We did release 2 new white papers. They are out on our website, and you can see them. One's on inflation, and the other is on the role of cash, which we've kind of touched on a little bit today as well. And then as far as IQ's performance, give us an update on that.
So big picture, large cap funds have done well. Obviously large cap growth because of technology, the Magnificent Seven have shown the biggest absolute price appreciation. But value has done well from an absolute basis and on a peer ranking standpoint. I'd say mid cap has done well. Value has done much better than growth, for sure. The one category I'd say, if anything, people have kind of questioned and certainly not been happy is small cap. I think a lot of that has to do with interest rates, small companies tending to have more debt, and with the backup in yields that we've seen this year, that certainly has not helped the small cap area.
Yeah, they've been pretty volatile. They were up 6, 7, 10%, and now they're kind of back to break even.
Yep, absolutely. And I'd say international is kind of holding its own. We've had a few funds do very, very well. Other funds, kind of middling. But again, that has been impacted by the strong US dollar.
Yeah.
Then if we look on the fixed income side, obviously we had good absolute returns last year and our managers did well on a relative basis. This year has obviously been a little bit more difficult. I would say that in general, our managers have kind of held their own. In one area that I think has really stood out during this entire time period is our non-traditional category.
Yes, yeah, that's definitely been the bright spot. Now, when we talk about IQs, I want to interject another question that came in from one of the participants, and it was a question regarding asset value versus price. One of our clients had sent an article regarding a closed-end fund that was trading at a huge premium. And so I just wanted to start off mentioning that right now, we currently don't have any IQs positions that are technically closed-end funds, though we do have a couple of interval funds. And also, I should note that closed-end funds aren't inherently bad. Actually, many trade at a discount rather than at a huge premium like the example that was sent to us. So without going into great detail on the nuances of closed-end funds, interval funds, et cetera, the concept of asset value versus price, it's impacting all investments. It's really what drives the markets. Take a position like NVIDIA. Currently, I think it's trading at more than like 50 times its earnings. I think most people would consider that to be a premium in excess of what you would consider its asset value. But why is it trading there? Because it's trading in anticipation of future earnings power. There's other examples. You could say, well, what about Bitcoin? Technically, it has no asset value backing it. But, well, for that matter, some believe that there's probably even no value from a utility perspective either. Yet it's trading at $60,000. Why? Due to the perception that it's some type of store of value. Personally, I still quite haven't gotten my head around that one, Jonathan, but it's probably not that much different than, say, gold or art, which those two have literally zero cash flows, but they've deemed over history to have value. So in any case, when we look at asset value versus price, we recognize that there can be disconnects, but there's sometimes good reason for that disconnect. And when we're doing our investing and we're reviewing our IQ's positions and thinking about adding IQ's positions, there are many factors we take into account, including this concept of asset value versus price. However, our strategies are definitely not short-term in nature, focused on trading around anomalies or mispriced assets. Okay, we really try and focus on high-quality companies, strong earnings that will provide value over time as part of a diversified basket. So let's talk about enduring market cycles as we wrap up today's discussion. And I think here what I want to do is start with one of the things that we kind of touched on, and that is common investor concerns. We talked about sticky inflation, negative bond returns, the geopolitical risk, election worries. We didn't touch on high US government debt, but we'll touch on that in a few minutes. But all of these things could certainly cause somebody to stay out of the markets, or maybe to be focused just on the US because of these lagging international returns as a result of the strong dollar.
Or after last year, let's focus on the Magnificent Seven and concentrate our investments there.
Exactly. Looking at valuations. These things rarely have long-term impacts. And this is very difficult to read. So I don't expect anybody to really be able to see all of the details, but just talk through it.
So basically, this is looking at events going back to the 1970s. And then on the far right, they kind of put them in separate buckets. But if you really look at it, right in the circle, you'll see for 1 quarter and 1 year, we're looking at positive returns. And so while they can affect things in a 1 week or even a 1 month period, they don't tend to affect returns longer term.
So yeah, these geopolitical events, these types of happenings, they just don't, as Jonathan said, impact the markets much. Politics, honestly, they don't really impact the markets that much. I mean, we can see here, it doesn't really matter. Democrat president, Republican president, I don't really care which you are, the markets tend to go up. I explain the markets like a fishing bobber. The natural state of the market is to pop back up. And there'll be certain times where forces will pull it down. Typically it's temporary, and when those forces release, boop, the bobber pops right back up, just like the markets. Government debt. We didn't really touch on government debt in detail this time around. We will at some point again, but this article is from 1972. Government debt so far has had really no impact on equity returns. Some people say at some point it will, but we've been hearing this for the last 30, 40 years, and it has yet to be true. So to think that you need to shift your investment strategy over the next quarter or even next year as a result of of government debt, I'd be a little bit questioning whether that's appropriate.
So here, what we're really talking about is market timing, because I think with the markets having done so well, there's this natural inclination to say, I don't know if I want to be in the market right now. And so if we look going back to World War II, the annualized return for the market is 11%. If we look at that big purple circle, the return is 10.1%. And so that's basically investing at market tops. Yes, you can have pullback periods, and so your return would be, less, but even at market tops, it's certainly much higher than sitting in cash. So over that same time period, cash returns have been 4.2%.
So it really is about staying invested versus timing the markets, because here we see the markets are constantly making tops. I mean, that's the nature of the stock market, but you don't have to time it as long as you are invested. And of course, there are benefits to diversification as well.
Yeah, so here we're looking at a portfolio of just stocks or just bonds, or a 60-40 blend, 60% equity, 40% bonds. And what we're really wanting to show is that, yes, in a one-year period, you will have some volatility and can have some big negative returns. But when you look at 5, 10, 20-year averages, that loss over time just really lessens. And so having some bonds in a portfolio and not just having stocks provides you that downside protection, and then you're compounding your returns over time from a higher level than would have been if you were just in stocks.
And it doesn't mean 60-40 is what everybody should have.
Right.
This is just example purpose. Absolutely. And then, of course, diversifying across economies or countries.
Right, because some people wonder, and certainly we've talked about international investing over time. Many of the strategists we talk to, everyone feels that international makes sense. But if you just really want to look at it, if you look on the left, this was the world in 2008, and now in 2022. Really to focus on that dark blue, the emerging market economies, they make up now almost half of the global economy, and therefore over time we should expect investments to start mirroring that.
Sure. Not to say that we're allocating 20% or 40% or anything like that to emerging markets. We keep our allocations there very small because we invest on a per unit of risk, right? We don't invest per capitalization. A lot of risk comes with the emerging markets, so we allocate fewer dollars there relative to the US. And then, of course, this is one of my favorite slides, the quilt chart showing in a calendar year, columnar fashion, the best performing category versus the worst performing. Each category is color coded. At far right, you'll see large cap stocks. They're the best in 2023 and year to date in 2024. The point here is that if you have asset allocation as a foundation of your strategy, you're never going to be at the top. I mean, that's just part of having that diversified strategy. But you're also never going to be at the bottom. And you can get good, consistent, long-term performance by having that diversification without having to try and time which is going to be the best performing category over others. Okay. Now, we did have another question that we wanted to touch on here. Somebody asked about AI, artificial intelligence, and how we're using artificial intelligence in our investing strategies. Do you want to just briefly touch on that as we come to a close?
Yeah, so essentially for SilverOak, we don't utilize AI in making investment decisions, but it is actually touching the entire market carpet that we're seeing. Certainly from an investment standpoint, Large cap growth has a lot of technology. And so there are AI companies within that weighting. But more importantly, though, many of our managers are utilizing it in some fashion. Certainly, when you think of hedge funds and trading strategies, they can utilize AI to kind of sniff out some patterns and anomalies. Even when we think of some of our value managers, they're using machine learning to read through a lot of legal documents and disclosures. So they
Go
use
through
it,
financial statements.
absolutely.
Yep.
So they use it as a tool. But also the other thing we have to remember is that a lot of companies themselves are starting to use AI to become more efficient. So it is going to touch the investment community in many ways, obviously the economy and the markets.
Yeah, and I would say, you know, when we think about AI, every company across all of these asset classes will ultimately use AI to help improve their earnings. And earnings are obviously the drivers of stock price. Those that use it best and are most efficient at utilizing it will ultimately probably be rewarded in their stock price and the price appreciation. And I suspect at some point we'll adopt AI in some fashion. Right now it's being used more as a trading tool. We don't do day trading. We're not looking at those small little anomalies. We are looking at big picture, longer term strategies that have been proven over time. Now I will tell you personally, I've used ChatGPT. I have a subscription to ChatGPT, and I would just be very cautious of how you utilize AI today, because almost every research project I do, especially those related to taxes, I'll throw into ChatGPT and see what results I get. And I would say at best, 50% of the time, it's accurate. And probably at best, the 50% of the time that it's accurate, it's still not fully disclosing all of the nuances that you need to be aware of with that particular tax research project. So even the most basic items that you throw into these AI tools, you got to be very cautious right now. It's at the very beginning stage of this new technology, and I'd be just careful. Where we really focus on the things that you can control. So there are some things completely out of your control, right? What's going to happen in the markets, monetary, fiscal policy. I mean, you can control it somehow, maybe by, you know, voting, but very little direct impact. Some things you have a little bit more control over, right? Employment, earnings. Well, I don't know about longevity, I guess. Eat well.
Healthy,
Yeah,
exercise.
exactly. But there's other things you have total control over. Your savings, your spending, your asset allocation, asset location. I mean, these things make, honestly, the biggest difference. And you have total control over these items. And that's where we tend to focus our time and effort, and we hope our clients focus their time and effort. So with that, if you have any additional questions or topics, as usual, we encourage you to reach out to your SilverOak advisor, or you can reach out directly to me at 952-896-5701. Thank you, Jonathan, and thank you for everyone who attended today's webinar.